It has been known by many that the technology sector has largely carried the load for the past 12 to 18 months within the stock market. Three of those that have played a huge part have been Nvidia, Microsoft, and Apple. And in today's video, we're going to take a look at all three of those. There might be some of you investors that have been sitting on the sideline, or you have some money to put to work here soon, and you're looking at these three stocks asking, are they still a good buy even after the performance they've seen? Again, past performance doesn't necessarily indicate what future performance is going to do. And in today's video, we're going to hopefully help you answer some of those questions by taking a closer look at Apple, Microsoft, and Nvidia, looking not only at their past performance, how the company is performing today in terms of operating margins, in terms of revenue growth, EPS, free cash flow, and the list goes on. And of course, we're going to take a look at valuation, and I'll be giving you my price targets as well as analyst price targets as well. But before we do jump into today's video, do me a huge favor, click that like button down below, subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is Cashflow University, the premier options trading community out there today. Whether you're brand new to investing in options or you're a seasoned trader, Cashflow University has everything for you. Within this community of options investors, they all have one goal in mind: to build wealth and build income with the use of options, where you can follow along with the CFU teachers or just other members of the community. I'm a part of this community, and I love seeing all the different trade ideas that come in from not only other teachers as well as other members. You can get trade alerts, see the exact setup of trades from the numerous teachers within CFU. Check out the link down in the description below, and trust me, the trades certainly pay for the membership and more each and every month. All right, let's jump back into today's video, taking a look at three popular technology companies: Apple, Microsoft, and Nvidia. Apple for years was the largest company in terms of market cap in the US. But earlier this year, Microsoft took that crown. But the fastest growing company has been Nvidia, and before long, we will see Nvidia as that top spot in terms of market cap. Let's first begin by looking at past performance, and this comparison is not a close fight. Nvidia is the clear frontrunner over the past 12 months, gaining 175%, compared to Microsoft gaining 25% during that time, and Apple only up 7% and the clear laggard of the group. So again, Nvidia has been fantastic, and I have enjoyed every single bit of this run. But if you're putting money to work today, which of these three stocks is the better buy? In today's video, we're going to take a look at a number of different angles when it comes to each of these three companies. Some of those fundamentals include safety of the balance sheet, past revenue growth, future revenue growth, operating margin, free cash flow, and free cash flow margin, among other things. So let's first begin by taking a closer look at Apple, which is a company, when you're looking at the bottom line, that hasn't really been growing at all, really, over the past 3 to 4 years. One thing that they've done that has masked that lack of growth has been buying back billions in share buybacks. So if net income's the same, but the amount of shares that they're multiplying to get to EPS is lowering each and every year, it's going to make EPS grow. However, the organic growth in terms of net income has been non-existent. So given this, is the company's best days behind it? Let's dive in, beginning with the balance sheet. So as you can see here, the company has cash on hand of about $67 billion. Their current ratio is at 1.04. Anything above 1 is solid. And they have a quick ratio, which we're also looking for a score above 1, is at 0.87. So it's right on the border right there. So a balance sheet is always important to assess, and Apple has a great one. Next, let's take a look at some of the operating results, where over the past 12 months, revenue growth has been non-existent. It's actually been negative 4.3% over the trailing 12 months. Operating margins, though, came in at 31%. That's above their 5-year average of 28%. Free cash flow for the company is surpassed $100 billion at 102, and free cash flow margin is at 27%. So fundamentals have been okay, but there also is, looking forward, the potential for a super cycle. We have AI-related phones coming on. We have AI-related MacBooks coming on. Apple could be a sneaky AI play moving forward. Next, let's take a closer look at valuation, where analysts are looking for next year's EPS of $7.21, giving the company a forward PE ratio of 26.6 times, which is above their 5-year average of 25.3 times. However, the company is evolving and much different than they were 5 years ago. Next 3 years, analysts are expecting EPS to grow on average 9%, giving the company a PEG ratio of 2.8 times. In terms of enterprise value to EBITDA, which is a metric I like to look at, the company currently trades at 23 times, which is above their 5-year average of 20 times. So we're going to take a look at each of these companies moving forward, the same exact statistics, and then we'll kind of do a summary at the end. So next, let's move on to Microsoft, stock ticker MSFT. Microsoft currently holds the top spot as the most valuable company in the US in terms of market cap, with a market cap of $3.1 trillion. But how long will they be able to hold off Nvidia? In terms of the balance sheet, the company has cash on hand of $80 billion, a current ratio of 1.24, and a quick ratio of 1.05. So both of those balance sheet ratios above 1, showing this company has a fantastic balance sheet. And they are one of only 2 companies with a AAA rated credit rating, which speaks to the safety of this company. Next, let's take a look at operating results, where over the past 12 months, revenue growth has been 17%. The company has operating margins of 45% with a 5-year average of just 40%, free cash flow of $70.6 billion, and a free cash flow margin of 30%. Fundamentals have been very solid for this company, and they are very well diversified, which speaks to both the safety and quality of this company. Microsoft is enriched in AI, cloud, gaming, cybersecurity, and so much more. Next, let's take a closer look at valuation, where analysts are expecting next 12 months EPS of $13.30 per share, giving the company a forward PE ratio of 31.2 times, which is slightly below their 5-year average of 32.3 times. Over the next 3 years, analysts are expecting average annual EPS growth of about 16%, giving the company a PEG ratio of 1.9 times. They're also trading at an enterprise value to EBITDA ratio of 25 times, which is slightly below, or slightly above, I should say, their 5-year average of 22 times. And lastly, let's take a closer look at Nvidia, stock ticker NVDA, which is the fastest growing of these 3 technology companies. Just when you think this company, how could they surprise investors yet again? They do it again. And demand continues to be off the charts for Nvidia chips. So let's begin by taking a look at the balance sheet. The company has cash on hand of $31.4 billion, an impressive current ratio of 3.53, and a quick ratio of 2.88. Again, we're looking for scores above 1. Above 2 is simply fantastic. When we look at the operating results, these are going to be some insanely impressive figures. Past 12-month revenue growth, 262%. Operating margin, 60%. Free cash flow, $39.3 billion, and free cash flow margin coming in just shy of 50% at 49%. Growth is impressive, but these comps are going to be difficult as the company moves forward, which is going to adjust valuations moving forward as well. Let's start to look at some of those valuations now. In terms of EPS estimates, analysts are looking for the company to generate $26.52 per share, giving them a forward PE ratio of 41.3 times, which is below their 5-year average of 48.8 times. Over the next 3 years, average annual EPS growth of 51%, giving them a PEG ratio below 1 at 0.8. The company also trades at an EV to EBITDA of 54 times, which is below their 5-year average of 57 times. So it's very impressive to look at the growth that we've seen from Nvidia and still look at valuation saying it's not all that crazy. Now let's start to put some of these and summarize a little bit by putting these 3 companies together. Let's begin with the PE ratio and the 5-year average for each company. For Apple, they're currently trading at a forward PE of 26.6 times. They have a 5-year average of 25.3 times. For Microsoft, a forward PE of 31.2 times and a 5-year average of 32.3 times. And lastly, Nvidia, with a forward PE of 41.3 times and a 5-year average of 48.8 times. Now let's add in and take a look at enterprise value to EBITDA, where Apple trades at 23 times with a 5-year average of 20 times. Microsoft with an EV to EBITDA multiple of 25 times. compared to their 5-year average of 22 times. And Nvidia trading at an EV to EBITDA multiple of 54 times compared to their 5-year average of 57 times. So only Nvidia is trading below their 5-year average. However, their 5-year average is quite high, and we do expect that to come down as the company matures. So there we just looked at various different valuation multiples, but you may still have questions wondering which of these stocks is the better buy. What we're going to do next is we're going to look at some price targets. I'm going to give you both my price target moving forward, as well as the average analyst price target moving forward. And you can kind of compare or maybe average those two out to make a decision that works for you. So let's begin with Apple. And when it comes to Apple, this is a company that's improving margins. It has that AI potential moving forward, more annual reoccurring revenue, which investors are willing to pay higher multiples for moving forward. So it's hard for me to look at Apple's 5-year historical average. For me, I probably want to take a closer look at their 3-year average, which is going to show an increase valuation. So when it comes to my personal opinion, I believe that a multiple of 27 times earnings is warranted for Apple moving forward over the next 12 to 18 months, as the company expects to generate EPS of $7.21 per share next year. This would give them a forward price target of about $195. Analysts are a little bit more upbeat, with an average 12-month price target of $208 per share, implying 8% upside from current levels. Next, let's take a closer look at Microsoft, which is another juggernaut. This is a company that operates quite efficiently, higher operating margins than we just saw with Apple, and more annual reoccurring revenue to go along with a fantastic management team. I believe a multiple of 35 times is warranted for Microsoft moving forward. And with the company expected to generate EPS of $13.30 per share next year, this would give them a forward price target of $452 per share. Analysts, again, a little bit more upbeat with an average 12-month price target of $492, implying 18% upside from current levels. And finally, let's take a look at Nvidia, which is that shiny new object out there. They have unparalleled demand. They easily have the best product out there on the market today, and everything around AI comes back to Nvidia. I believe a multiple of 40 times is warranted for Nvidia moving forward, and with the company expected to generate EPS of $26.52 per share this year and $34 next year, this would give them a forward price target of $1,210. Analysts are pretty much on the same page with me, as they have an average 12-month price target of $11.98, implying 9% upside from current levels. So with that being said, when we really look at it, all three stocks are trading a little bit elevated. I think the biggest shocker is the fact that when you see the stock performance that we've seen, the move higher in Nvidia shares, but when you look at valuation, it's not all that crazy at all. It's elevated, but it's not crazy. When you see moves like that, you would expect extremely high PE multiples, extremely high price to free cash flow multiples, extremely high EV to EBITDA. But when you look at them, they're pretty much in par with the company's 5-year historical average, which is just wild to me. When I look at Apple around that $200 per share price is a tough pill to swallow. So when I look at all three of these stocks, and if I had to pick one, if I'm putting new money to work today for me personally and my portfolio, I'm probably first going to be looking at Microsoft, a very well-diversified portfolio, whether it's AI, cloud, gaming, or their suite of Microsoft Office, or even cybersecurity. I love everything that Microsoft's doing. Next, it would probably be Nvidia, and the laggard of the group is going to continue to be Apple, in my opinion. So that's the way I would go. But in the comment section down below, let me know what would be the stock that you would be most likely to buy at today's valuation, and which stock would you be least likely to buy of these three. And if you enjoyed the video and you haven't done so yet, make sure you help me out by hitting that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.